चलेगा।
So we are doing the sum of investment appraisal of May-June 2023, paper 42. You're asked to calculate the net present value. Can you tell me, when you're asked to calculate the net present value, the first thing that you need is what?
Cash flow. The influence.
Net cash. The first thing that you would need is the net cash flow. And how do you get the net cash flow? You get the net cash flow by inflow minus outflow.
अच्छा.
Okay. So Barry has performed a survey of Farmers Field, which is on site of ancient settlement. Can you please read it? Can you read
Barry
it?
has performed a survey of a farmer's field which is on the site of an ancient settlement. He has government permission to dig up items from that settlement and sell them to museums around the world as long as he pays a percentage of the proceeds to the government. So the following information is available. Payment to the farmers for the right to dig in the field for 4 years is $100,000.
So
which
this
is paid before
$100,000 denotes what?
the initial investment.
The initial investment. So the initial investment in year 0 is 100,000. So this is the outflow. Discount factor would be 1. This is the discounted flow.
Yeah.
Yeah. Can you read ahead?
Yeah. Estimated sales proceeds from the museum, 500,000 over 4 years. Proceeds are expected to be received in line with the progress of the dig.
Okay, stop. So 5,000 is to be received over 4 years, right?
Yeah.
500,000. And how are you going to receive this 500,000?
They're
In
supposed to be
line with the
received in
progress
line.
of the dig.
Yeah.
So you have the progress of the dig over here.
Yeah.
Yeah. So
Yeah.
45% is in the first year.
Oh, so it'll be 225,000 for the first year.
25% in the second year. Then 20% progress of the dig in the third year. And 10% progress of the dig in the fourth year. So you are going to receive 45% of 500,000, that is 225 in year 1. 25% of 500,000, that is 125 in year 2. 20% of 500,000, that is 100,000 in year 3. And 10% of 500,000, that is 50,000 in year 4.
Yeah.
Are you with me?
Yeah.
Okay. Then there is another cost, that is payment to the government. 10% of the proceeds are paid in the year in which the proceeds are received. So 10% of the inflow of the proceeds is paid to the government.
Yeah.
Are you with me?
Yes.
Come
So it'll
on.
be 22,500 in the first year. 12,500 in the second year. Then 10,000 in the third year. Then 5,000 in the fourth year.
Okay, very good. So you had the payment to the farmers?
Yeah.
This 100,000 is gone. Then
the cost of the dig.
Payment to the farmer for the dig, for the right to dig in the field for 4 years is 100,000. Estimated sales proceeds are given now. 10% of the proceeds paid in the year in which the proceeds are received. Okay. Come on, read ahead.
The progress of the dig with regard to the removal of ancient items and the additional associated costs are expected to be as follows.
Okay, so the progress of the dig is for this, and this is the additional costs. Additional associated cost. So
you
this
will put it in the outflow.
Associated cost will also go in the outflow.
Yeah.
And you have the discount factor. The cost of capital is 10%. So you get the net cash flow. That is the inflow minus outflow. Inflow
Yeah,
minus outflow.
minus outflow.
Inflow minus outflow. Inflow minus the outflow. Inflow minus the outflow. Your net cash flow is this much. Multiplied by the discount factor, you will get the present value.
Hmm.
So your NPV is 22,037 positive.
Yeah,
Are you with me?
yeah.
Now what you have to calculate?
The payback period.
Okay. So you have to calculate the payback period. I will take this.
Yeah. You'll need the year and the cash flow.
You will need the year and the cash flow.
Yeah, the net cash.
Okay, fine. So in year 0, there is a net
Outflow
cash
100,
flow of how much?
100,000.
100,000. Okay, this is your initial outflow.
Hmm.
In year 1, what is the cost of your project?
100,000.
100,000. So
Hmm.
in year 1, you are getting how much? 86,000. In
Hmm.
year 2, you are getting how much? 14,000.
14,000.
86,000 plus 14,000, 100,000.
Hmm. Yeah.
We do it at the payback period, we do like this. We put the years and we put the net cash flow.
Hmm.
Then we find the cumulative net cash flow. And so in the first year, it is negative. Yeah?
Yeah.
So now 100,000 minus 86,000.
We'll give you negative 14,000.
We have a negative 14,000.
Yeah.
Now
And then you get
14,000 minus 14,000,
will give
we
you
get
0.
0. So that means the payback
Pay,
period is 2 years.
yeah, between, okay. Straight away 2 years.
So at the end of 2 years, you are going to receive the investment.
Yeah.
The third part, what is the third part? Find the accounting
The,
rate of return.
this is the formula one, no?
Yeah, accounting rate of return. What is the formula for accounting rate of return?
Average profit upon average investment.
So ARR is what?
Average profit upon average investment.
Average profit over average investment.
So you will add all the net flow amount, right?
So there is no depreciation right now.
No, there's no
Is there any
depreciation.
depreciation? No. So
No.
average profit would be inflow minus outflow. Inflow
Yeah.
minus outflow.
Minus.
There is no depreciation. So the net cash flow is only your average profit. 45,000 would be earned over 4 years.
Yeah.
Average investment. What is average investment?
100,000.
100,000 for what? 100,000
For 4
divided by 2.
divided by 2. So
So average
50,000.
profit is 11,250. Average
Divided
investment is 50,000
50,000.
into 100.
Yeah.
So the accounting rate of return is 22.5.
22.5%.
With me?
Yeah.
Next part, the B part. Advise Barry whether he should go ahead with dig in the farm. Justify your answer. What is the NPV? Can you tell me?
NPV is 22,037. So he
Payback
should
period
2 years.
and ARR
22.5.
22.5%. So NPV is positive. That means it is financially beneficial.
Yeah.
Payback period is short. That means you're going to recover your money in 2 years. ARR is more than your cost of capital. Cost of capital is 10% and you are getting an accounting rate of return at 22.5%.
Yeah.
NPV is considered the most reliable method. Okay. So you can go ahead. Though there is a short payback period, but you have to speak something negative also, right?
No.
So although it is a short payback period, but it is a risky venture.
Mm.
Okay.
Yeah.
He might not be certain about his plan of dig up. He might not be able to have sufficient cash flows. His cost can be more. Now, this you have to write abruptly. But
Yeah.
as per the techniques, he should go ahead with the dig of the farm field. Okay?
Yeah.
Negative may you can write the cost can increase. The plan might not be, it might not be as per the actual plan. It might turn out to be risky.
Hmm.
Okay. However, since the NPV is positive, it is financially benefited, it's going to be returned in a very short period of time. You can go ahead with the project.
Yeah.
Two disadvantages of ARR.
That it doesn't take cash flow into account, which is less subjective, and it ignores the
Time
time
value.
value of money.
Okay. So with this, we complete the sum of May June 23, question number 42.